Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG, and we thought we'd come to you today with a brief market update, kind of let you know what's going on out there. The S&P 500 is back up at around 4,000, which is a level we've kind of flirted around for a while now. You know, we saw some weakness in March, largely around the banking crisis, which we are going to get to. And we've seen a pretty strong rally in the past couple of days up to about the 4,000 level. Feels like the market wants to hang around that technical number for a variety of reasons. Probably the biggest piece of information out this week is the Fed rate decision. The Fed decided to raise interest rates by 0.25% up to 5%. And the message really coming out of the Fed coming out of the Fed's meeting is, look, we understand that there is a banking thing going on. It's unclear to us what the impact of the banking thing will be. Too soon to tell, too soon to see it into the economic data. We know inflation is still a thing, and so we believe that we should continue on this rate tightening path. And at least based on the data that we're seeing right now, we would expect to maybe hike again, maybe once, maybe even twice, and then not reverse course on lowering rates really until 2024. Powell was very clear about, based on the data that they see today, that is sort of the dynamic that the Fed believes is appropriate given where the economy is. Meanwhile, Mr. Bond Market believes that that's hogwash. So if you look at all of the various prices of different durations of Treasury securities, the bond market is basically implying that by July, the Fed will be reversing course and starting to lower rates. Kind of I don't know if it's a bearish or a little bit of a bearish signal out of the bond market in terms of the overall health of the economy, that the Fed would see the need or that inflation would be under control or financial conditions would have tightened enough to the point where the Fed thought it was appropriate to move to a less restrictive stance with interest rates by the middle of the year. And it's interesting, once again, I would just note this sort of good news, bad news. The equity follows the bond. The equity markets really follow the bond markets more than they follow the Fed. And so despite this sort of bearish signal on the overall economy, equity markets have rallied based on the fact that interest rates are a little bit lower. So, as always, a little bit of a head scratcher when we get these, bad news is good news types of markets. I would just note that the 10-year Treasury is down to less than 3.5% after being well into the 4 range earlier this year. It's really the lowest rate we've seen in the past 6 months, which is an indication that, once again, the bond market feels like the Fed is probably done with its interest rate tightening cycle and maybe even, closer than everybody expects to actually easing up interest rates. And I think it's important to kind of understand the two elements that are at play here within financial markets as we think about, easing restrictions or easing within the data or tightening restrictions on companies. On the one hand, you have the banking crisis, which is sort of widely expected will cause banks to tighten up their lending standards. So when people get freaked out, when banks get freaked out, it seems like they may be less likely to run out and loan money to small and medium and large businesses, which has a contractionary effect on overall economic activity. Those businesses want to be able to borrow money, and if they can't, then that contracts overall economic activity. On the other hand, as that 10-year Treasury gets lower and as the 2-year and the 5-year get lower, it actually lowers borrowing costs for the borrowers that are able to borrow, which is expansionary. And one of the things that we've talked about previously on these market updates is this notion that, the price of the 10-year Treasury and the 5-year Treasury are probably more impactful than the price of Fed funds rates in terms of stimulating the economy or restricting the economy because those durations are normally, the length with which most companies are borrowing. So got a little bit of a mixed message going on within the economy. On the one hand, banks may be scared to lend, but when they do lend, they are lending out at lower interest rates, which is fundamentally a positive for businesses. So I think the answer is, with all, as it has been for the entirety of this year, we're in a little bit of a wait and see. We'll have to see exactly how restrictive banks get. We will have to see exactly what inflation starts to do. But for the time being, everyone's in a little bit of a wait and see mode, and the bond market and the Fed are giving you kind of two different signals. With that, as always, if you have any questions, please feel free to either reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you're having a great week.